Information technology. More than one out of every $3 of the entire S&P 500 sits inside a single sector, information technology. And I'm sure you've heard financial media all week and last week and the week before that. The crash is coming. Speculation. It's too high, right? One camp says this is a dot-com bubble all over again, bigger, faster, and about to end the same way. Bank of America just told its client that speculation is hitting extreme levels and put a year-end target on the S&P 500 that sits below where we are today. The other camp, you know, led by Yardeni, which I've been following for quite a bit, the man whose research firm actually produced a chart on your screen, just raised this year-end target to 80 to 50, more in line with what I'm thinking. And this is nothing like 1999. So you have two smart camps, same charts, opposite conclusions. So today, what we're going to do is as we have always done on this channel, we are going to slow it down. We're going to put the actual data on the table and walk through it line by line in plain English. No jargon you need a finance degree to understand. You'll know what it said in 1999 and what it said in 2008 and what it said in 2020. And most importantly, what it's quietly telling you to do with your own portfolio right now. Oil is spiking on renewed tension in the Strait of Hormuz. I know. And the Fed is openly talking about raising rates. And I'll tell you up front where I land. These charts contain a genuine black swan signal, but it's not the black swan most people think. We always talk about those rare high impact events. Everybody assumes these events are always crashes. They're not. Some of the most powerful rare events in the market history were melt ups, not meltdowns. Positive surprises so large the people who were hiding in cash missed a once move. Today's chart, read honestly, is telling a story about which kind of tale we might be living through. But don't forget, subscribe, membership before we dive in. If this is a kind of analysis you want every day and every week, do me a quick favor right now. Hit the subscribe button and tap that bell. Join as a member. It'll be worth it. So let's take a look at the chart. Let's take a look at the chart that I've been telling you. And what is it telling you? Well, this is from Yardeni Research using data from LSEG, DataStream, and Standard & Poor's. It's a weekly data point all the way back to 1995. 31 years of market history on one page, and it shows two lines for one sector, information technology. That is a sector that holds NVIDIA, Apple, Microsoft, Broadcom. The blue line is the market cap share. Here's the plain English version. Take total value of every technology company in the S&P 500, every share of every tech stock added up, and ask, what slice of the whole index is that? And right now, the answer is 37.6. Think of it as the S&P 500 as a big pizza. Take slices of that pizza, measured by price, is now more than a third of the whole pie. That is the highest reading of the entire history of this chart. Higher than the dot-com peak, the highest concentration in one sector that American markets have ever recorded. And the red line is the forward earning shares. And in plain English, instead of measuring tech by its size, measured by profits, analysts expect these companies to earn over the next 12 months. What slice of all expected S&P 500 profits belongs to tech? The answer right now is 34.4%. So here's the entire chart in one sentence. The blue line tells you what investors are paying for tech. The red lines tell you what the tech is actually expected to earn. And the relationship between those two lines, whether they move together or drift apart, is one of the most honest lie detectors in all of finance. So what do I call it a lie detector? Because prices can be driven by emotion, excitement, fear, crowd behavior, headlines. But earnings, actual profits, are much harder to fake over long stretches of time. Companies either make money or they don't. So when the blue line races far above the red line, it means investors are paying for a story that the profits haven't backed up yet. And when the two lines climb together, side by side, it means the excitement is being funded by real cash flowing into real companies. Look up at the chart right now, right? Blue line 37, red line 34. The gap between that investors are paying And what the techs are earning, 3.2 percentage point, all into that number, 3.2, because on a few minutes we're going to compare it to the gap that existed the last time everyone was screaming bubble. And that comparison is going to reframe everything you've heard in the financial television this month. And one more thing about the shape of these two lines before we get back in time. Notice that both lines aren't just high, they are rising together and steeply. The red line has gone almost vertically since 2023. It climbed from roughly 19% to 34.4% today. That is not investors bidding up prices. That is Wall Street owns analysts repeatedly raising their profit forecast. The single vision difference is the heart of today's entire video. So this is where it's important to understand the truth from the narrative. And the narrative sometimes is driven by them. And unfortunately, retail investors tend to believe the them because where do you get your information from, right? You look at the paper, you listen to the news, you look at what's happening, and they tell you that's the narrative is it's too expensive, it's too much. You shouldn't be in it. Sell. And you sell, they buy, and then they say, you know what? It's all good, right? And then you buy, and then they sell. And that's why it's important to understand two things: the difference between the truth and the narrative. But obviously, you need to understand the risk environment. That also is very important. That's what I'm here for. So let's take a look at this other chart, which is going to give us more of a perspective. The then and the now. So to understand what 2026 means, you have to walk through what this chart looked like, at every major turning point in the last 3 decades. This is the path most YouTube videos skip, and it's exactly the part that makes you a better investor. So let's take a look at it. Let's look around the 2000 period, the dot-com era. 1995, right? Tech was about 9.5% of the S&P 500 value and about 8% of its earnings. Balanced, boring, honest. Then the internet arrived in the public imagination, and something remarkable happened to the blue time. Between 1998 and March of 2000, tech market share exploded from 15% to almost 33%, in more than double in about 2 years, right? And the red line, the earnings line, it crawled from around 12% to 17.5%. That's it. You see the difference here. We grew 17% earnings. Well, the market cap grew a lot more, almost twice as much. Do the math with me, because this is the most single important calculation in this entire video. At the peak of 2000 price per share, roughly 33%. Earnings share roughly 17.5%. The gap more than 15 percentage points. Investors were paying for a slice of pizza nearly twice as big as the slice of profits tech actually produced. The market was valuing a story. The internet will change everything. And here's a cruel irony that every investor should tattoo them somewhere. The story was true. The internet did change everything. Amazon became one of the most valuable companies on earth. The dot-com investors weren't wrong about the future. They were wrong about the timing and the price. They paid 2010 prices in 1999. And when reality couldn't deliver profits fast enough, the blue line collapsed from 33 to about 15%. The NASDAQ fell nearly 80%. It took 15 years. Now look at the chart, right? The 2026. What are we doing? Well, look at it. Forward earnings 34%. Market share cap 37. This is more in line with what it should be. So it makes total sense. You see the difference? So you don't want that gap, which is what we had in 2000. So this is not 1999. We have an actual product. The thing is, you have to differentiate the noise from the sounds, right? The signals, the sound. You got to be careful. You got to watch out. You have to understand what's going on. They make it very confusing for you. Next, and that's one I think you're going to like. On this screen is a chart that I built from the Yardeni data, right? But instead of 2 lines, it shows just one, the difference between them. The blue line minus the red line. Price share minus profit share. I call it the honesty gap because it measures in a single number how much of tech's valuation is backed by expected profit and how much is running on pure sentiments. Walk the timeline with me, right? In 2000, the honesty gap peaked from about 15 percentage points. That was the widest gap ever recorded. The market paying nearly double the tech slice relative to what tech earned. We know how that ended. From 2004 to 2016, the gap over near zero. Sometimes tech even traded at a discount to its earning shares, which, by the way, marks some of the best buying windows in the area. right? In 2021, the gap widened to around 4 to 5 points. And 2022 duly delivered a painful correction that closed it. As of today, July of 2026, with techs at its highest price share in history, 37.6%, the gap is 3.2 percentage point. Let me see that clearly because it is headline finding of the entire hour. Tech's market share is at an all-time record, but the gap between its price and its profits is running 1/5 the size of the dot-com peak, not a little smaller, 5 times smaller. This is why a guy like Yardeni, again, the researcher whose chart started this conversation, pushed back so hard this past weekend against a bubble comparison. His argument, in his own framing, is that the late 90s melt up was driven by fear of missing out, while today's market is driven by earnings momentum. The chart backs him up. In 1999, the price line went vertical while the price line slept. The profit line slept. In 2026, both lines are vertical, and there's only 3 points apart. Now, I've already heard the sharpest viewers pushing back, and I love you for it. You're saying, wait, the red line is forward earnings. Their analyst forecast can be wrong. And you're right. Forward earnings are expectation, not cash in the bank yet. But if analysts are systematically overestimating that profit, that red line can be revised downward and the gap would widen instantly without a single stock moving. But here's the thing about the last 3 years. Analysts haven't been overestimating. They've been underestimating over and over. NVIDIA has beaten expectation in essentially every quarter of the AI era. Its latest reported quarter. The red line on the chart doesn't keep rising because analysts are dreamers. It's been rising because reality keeps outrunning dreams. Let us take a look at the economic backdrop, because I think that's important. Right? A 3.2 honesty gap can be perfectly safe in one economy and fragile in another. So let's put today's chart into today's economy, and I mean literally today, the second week of July, because this has been one of the busiest news week of the year. Start with interest rates, because rates are the weather that every stock lives in. The 10-year Treasury yield, the single most important number in global finance, the benchmark for mortgages and car loans, sitting at around 4.5 or so percent. The 2 years at 4.3, the 10-year, the 30 years is knocking on 5%. Why do rates matter so much for this specific chart? When you buy a tech stock, you're buying profits that arrives in the future. The higher interest rates are, the less that future profits are worth today, because you could just park money in a government bond instead. Higher rates are gravity for high growth stocks. And right now, gravity is not weak. And it may get stronger. And that's where the story gets interesting. We have a new Federal Reserve chairman, right? Chair Warsh. And last Wednesday, speaking at the Central Bank Forum in Portugal, he said something Fed chairs rarely say out loud: prices are too high. He declined to commit to anything for the July meeting, but the market heard him loud and clear. At this point, future markets are pricing roughly a 50 to 58% that the Fed raises rates as soon as September, not cuts, raises. Think about what that means for our chart. The last time the Fed turned meaningful hawkish into a hot tech market was 2022. The blue line corrected several points until it landed on the red line, a red hiking. Fed is a stress test for the honesty gap. The good news, at 3.2%, the gap has never entered a hiking cycle this small at this level of concentration. The cushion is thin, but it's real profits, not history. Second ingredient, oil and geopolitics. As I record this, the market is dealing with exactly the kind of tail risk event we studied on this channel. President basically declared that the U.S.-Iran Memorandum of Understanding is over after attacks on commercial vessels. U.S. forces carried out strikes overnight and oil is going up. And the Dow fell, but obviously an LNG carrier was hit by projectile leaving the strait just yesterday. So third ingredient, the job picture. Last week's data showed private payroll growing by 98,000, below expectations. Translation for normal humans, the economy is cooling gently, not collapsing. That's actually the friendliest possible backdrop for stocks. And of course, the fourth ingredient, the big one, is the spending wave underneath the entire red line of our chart. Look at what the hyperscalers are spending money on. The four giant cloud companies, Microsoft, Alphabet, Amazon, Meta are on track to spend roughly $650 billion on capital investment this year, most of it on data center. NVIDIA expects that hyperscaler number to approach $1 trillion next year. Alphabet alone has guided 180 to 190 billion. And that figure doesn't even include OpenAI, Anthropic, and all the other guys that's happening in China. That spending is a physical, concrete, steel, and silicon reason the red earnings line has been gone vertical. One company's spending is another company's revenue. When Microsoft buy $100 billion worth of chips and server, that money shows up as profit at NVIDIA, Broadcom, Micron, which pushes tech earnings share higher. So the full economic pictures of today, rates high, possibly going higher, oil spiking, a labor market cooling, and a capital spending boom with almost no precedent in economic history. A complicated sky. Now, let me show you why instead of complicated skies, right? I see a positive tail forming. Because what you could see happening, frankly, is the Fed getting its house in order. No need to raise rates. We're still spending money on AI. We don't have such a huge amount of money in terms of oil going up, because eventually they're going to realize that they don't want a full-blown war, and the economy being what it is and employment not so high, and the other guy's still spending money on AI. By you listening to the pundit telling you it's too high, it's collapse, it's 1999 all over again, while they're buying, you're not. FOMO. Take a look at this, right? Talk about Black Swan a lot, but which is, you're thinking crash, right? It's a massive surprise. The rise of the internet was a black swan. The smartphone was a black swan. Nobody's 20 spreadsheet had $1 trillion app economy in it. The COVID crash was a black swan. But so was what followed, one of the fastest bull markets ever recorded, and $1 trillion app economy. The COVID crash was a black swan. So the most under-discussed risk in investing is not being in the market when the storm hits. It's being out of the market when the miracle hits. So ask a question honestly here. What does a positive tail look like from here? What is the upside? Surprise that today's consensus is not pricing in. Well, here's the setup. Wall Street today is split between modest gain and correction coming. Right? Bank of America is saying 7,100 by year end, and Yardeni is saying 8,250. Almost nobody's official forecast contemplate the third scenario, that the earning estimates are still too low. And yet, that is exactly what the last 3 years of data suggests keeps happening. Look at the chart on your screen. NVIDIA fiscal 2024 $61 billion in revenue for the full year. Fiscal 25, 130. It's more than double. And its most recent reported quarter for May was 81 billion, the quarter in 90 days. That single quarter was bigger than the entire company past 2 years earlier. Every one of those results beat the forecast that existed beforehand. The red line on the Yardeni chart, remember, that's forward earnings. Now, stack on top of that what we know about committed spending, roughly $650 billion in hyperscaler investment this year, a projected path toward $1 trillion next year. Order books that NVIDIA say gives it visibility years ahead. Taiwan Semiconductor expanding capacity because its consumer has already told it demand is coming. This is not speculative money that could vanish with a mood swing. Much of it is budgeted, contracted, and physically under construction. Of course, there are risks. Right? I mean, I wouldn't be fair if I didn't tell you about the risk. Well, optimism with the honesty is just marketing, and this channel doesn't do marketing, right? So risk number one, concentration itself. When you're looking at 37% of the index in one sector, the index is the sector. Your diversified S&P fund is, whether you like it or not, a leverage bet on AI infrastructure. If tech sneezes, your whole portfolio catches a cold. That is real. The silver lining awareness is the cure, and now you have it. The other 62% of the market, healthcare, energy, industrial, is trading at far more ordinary prices precisely because all of the excitement went one direction. Concentration in one place mathematically creates neglect and therefore value everywhere else. So in 2000, the mirror image of the tech bubble was that boring value stocks were the cheapest in a generation. The same seed is being planted right now. Risk number two, the forward estimate could be wrong. The red line is a forecast, and forecast bend. It's if hyperscalers pause their spending, if the return of on all those data center disappoint, the earnings share gets revised down and the honesty gap widens overnight. True. Risk number 3, the Fed. I mean, Chairman Warsh says prices are too high. Markets put better than coin flip odds on the September hike, right? They think and rising rates compress what investors will pay for future profits. But a hiking cycle into record concentration is a genuine stress test. Risk number 4, geopolitics. Who knows what's going to happen in the Strait? Maybe the U.S. decide to suddenly, bring troops in. That's also a very real issue. So let's take a look at finally the investor's playbook. Well, 6 ways to actually use this chart. Everything until now has been understanding. The question and this section is application. 6 concrete, plain English ways an ordinary investor can put this chart to work. And the usual reminder, I'm not a financial advisor, right? This is education, not personal advice. So number 1, know what you actually own. This is the single most valuable takeaway of the hour. Make sure you understand what you have. Number 2, rebalance. Rebalance on the calendar, not on a feeling, is a beautiful, boring secret. An investor who simply trims winners back to target waits once or twice a year automatically sells stacks when the blue line stretches too far. Number 3, watch the gap. Watch that level. It's important. Number 4, listen to the spending calls. The entire red line rests on hyperscaler capital spending. If you hear them not doing it, take it easy. Number 5, use the calm to buy your umbrella. The VIX at 17.5 means protection is below average cheap. Number 6, position for both tails. This is the heart of everything this channel teaches. You don't have to predict whether the next surprise is good or bad. You have to build a portfolio that survives the bad one and puts in a good one. So in closing, I will say this. I showed you 1 chart and 31 years, 2 lines, and here's everything we learned in 5 sentences. Tech now makes up 37% of the S&P 500, but it also produced 34% of the index. That's important. The risks are real. A hawkish new Fed chair openly saying prices are too high. Maybe he's positioning himself. Oil spiking in the Strait of Hormuz is real. Do we have a potential invasion? And forward estimates that still have to come true. We don't know. But the crowd can vividly imagine the crash because it remembers 2000. It cannot imagine the melt-up. That's the positive black swan hiding in this chart. Not a promise that nothing bad will happen, but the recognition that you need to understand where you are to realize how much money can be made here. And that's why it's important for you to understand the difference between the truth and the narrative.